we always advocate for getting advice first before you purchase an asset.
Yeah.
Get the advice, figure out what the right structure is for the problem that you're trying to solve for, and then purchase the asset.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. We are back again and back in the recording studio.
Andrew, favourite time of the week, coming over the airways, coming over the wireless to our listeners and our viewers.
Ran out of synonyms. Here we are, and we're getting it back on track. Bills, what are we talking about today over the airways?
That's it. We're talking about asset protection strategies. So something that we've covered off in the past, but we thought it'd be a fitting time. We've had a few of these conversations of late with people and clients, and just thought it was a fitting time to sort of bring this back up again to run through, some of the things that we think about and talk to people about when we are considering the assets that we do have. What are some of the things to think about from a risk perspective? But more importantly, is there anything that we can be doing and should be doing in order to protect those assets?
Yeah, absolutely. I mean, look, any financial planning and any wealth creation strategy is and should be underpinned by, great, we've accumulated all of these assets and that's fantastic. But how do we make sure that after we've, accumulated these assets, that we're actually retaining these assets and, it's not at risk of potentially being grabbed by any third parties? Yeah.
I mean, we might preface this a little bit just on the third party stuff. So when we tend to think about asset protection, this is one that comes up a fair bit.
Yep.
I guess that when we're talking about asset protection, we're generally coming at it from the position of protecting your assets from potential creditors down the track.
Yeah.
One of the big ones that we see is maybe a relationship is on the rocks. There's a family unit that, two members of a couple that have been married or have been in a de facto relationship for a long period of time, and one member of the couple gets the bright idea of being able to try and shield assets from them to try and sidestep some of their family law obligations. I just getting it out there. That's not what we're talking about here.
What's illegal?
Family law absolutely trumps everything anyway, so you can't do that. So we're not actually talking about that type of asset protection per se. This is more so from a creditor's perspective.
And that can be protected. I mean, at the end of the day, so long as you're entering into a BFA, like a binding financial agreement, you've got a lawyer involved, and there's two parties that are knowing, willing, going into a relationship with, this is touch wood. If it was to, or the relationship was to break down, this is how we'd like to separate assets, then that's fine. You can do it pre-relationship, you can do it during relationship, so it doesn't necessarily only need to be pre-relationship. But what we're talking about here is protecting your assets from creditors, not protecting your assets from any relationship breakdown.
Yep. All right, let's make a start, Andrew. I think the first one that we tend to think about, and in a really simplistic concept, is separating personal assets from business assets.
Yeah.
And the reason why we use that distinction is because if you've got a business that you're operating, obviously we'd like to assume that you're assuming a greater level of risk associated with operating that business, where you're dealing with a product or a service. And if something goes pear-shaped, maybe someone comes after you to try and recover some money because of some loss that they've incurred. So kind of 101 stuff for us is looking at it going, okay, can we separate out personal assets versus business assets? Andrew, you've got an idea of what that looks like with a practical example?
Yeah, I mean, look, a perfect example that we, see for a lot of business owners, particularly business owners that are in an occupation where there is a high chance of litigation.
Mm-hmm.
So what you might typically see is simple scenario. Okay, we're purchasing the family home. Family home's going to be owned in a spouse's name rather than only in my name,
mm-hmm.
Or being owned in joint names. And so you're just separating out your assets from who's going to be the person that's in a higher risk occupation that's got a higher likelihood of potentially being, sued or litigated against in the future. And in that instance, you're basically holding the, assets in the person's name who is going to have less likelihood. I mean, you think about, someone that works PAYG, doesn't necessarily assume any risk in their occupation. It might be a good idea to just simply hold assets in their name rather than your own.
Yeah, so 101 stuff for us in terms of our thinking is if there's business directorships, that's probably one where we look at and go, okay, if possible, you want to be able to own assets in the name of the non-director spouse.
Yep.
That's probably the first port of call that I'd go to with that one. But the family home is very common. Once again, going back to the family law overlay, whether, if you're a member of the couple and there's no binding financial agreement in place, whatever assets that you've got form part of the marital pool.
Yep.
Marital pool. There's a bit of a tongue twister for us. So if the relationship broke down, it wouldn't matter whose name the assets were in.
Yep.
From a family law perspective, that gets taken care of with the family law. So that's probably, the most common one that we see for ownership for the owner occupier. Andrew, what about things like a different type of vehicle, like owning assets in a trust?
Yeah. I mean, look, owning assets in a trust is another mechanism to be able to do it. I mean, one, it creates a separate legal entity, right? So you're talking about separation business assets from personal assets. That's another mechanism to be able to separate those assets out. Now, a trust can still be accessed. So just because assets are in a trust, it doesn't necessarily mean that if liquidators or if litigators or anyone was trying to come after your assets, that they wouldn't be able to access the assets within a trust, which is a very common misconception. But what it does mean is that it's a lot more difficult. You have another barrier, you're creating another hurdle, you're creating something that just makes things more cumbersome if someone was to try to come after you for your assets. There are some considerations with it, and that's with everything that we're talking about here. A lot of the times or two of the things that work in opposite with each other is tax minimization and asset protection. And sometimes those work well together, but a lot of the times they're working as two opposing forces. So for instance, we'll talk about maybe an investment property. You might consider holding an investment property for asset protection purposes in trust. However, when you're looking at it from a tax minimization side of things, that may not necessarily be, or from a tax minimization, it might work, but from a cash flow minimization, it might not. Consider costs to open up a trust. Consider the fact that the stamp duty costs of purchasing an asset within a trust are more expensive. Your land tax costs are more expensive in a trust rather than individual. And in addition to that, if the property is negatively geared, you can't actually distribute losses to members of the trust. And so as a result, it can mean that your tax minimization strategy and your asset protection strategy are working in sort of opposite of each other. And so a lot of the times when we're talking about these things, we're presenting options, we're presenting, hey, these are some of the implications. You're getting in a lawyer, you're getting in a accountant, and you're all kind of workshopping something for a client-specific scenario that's ultimately going to work out as, the best outcome at the end of it.
Yeah, and I think you're right in terms of, sort of what yields the most favourable result for the situation that you're trying to solve for. As an example, if you've got, and we always advocate sort of the opposite of this, but if you've got existing assets, if you then move them from one ownership structure to another, chances are you're going to trigger some sort of event where you're paying tax, whether it's a capital gains tax, where you're re-incurring stamp duty or what have you. So where I was going with my comments before is we always advocate for getting advice first before you purchase an asset. Get the advice, figure out what the right structure is for the problem that you're trying to solve for, and then purchase the asset with the initial purchase in the right entity or the right way at that point in time. Because after you've got the asset, when you move stuff around, it does get quite expensive. And it could be that, you're creating more of a financial burden than potentially the issue that you're trying to solve for down the track. So keeping in mind that, you probably want to do this stuff at the start and get the structuring right at the start rather than needing to move the assets around after the fact, after you own them.
Yeah, and make sure that you're reviewing it as well. I mean, perfect example is, someone who may be a business owner, owns the property in a partner's name, who's not a business owner and as a result is not assuming as much risk. It's an owner-occupied property. And at some point in time, they decide to upsize the family home. Well, now what happens is if the ownership is still left in one person's name and that asset was to be sold in future years, then you're creating a capital gain, and all of the capital gains tax is payable by one person. So one of the things that you really need to consider is, okay, circumstances have changed or something's changed. Make sure you're getting advice, because in that instance, you can look at transferring ownership from one individual to joint ownership while it's an owner-occupied property, potentially not incurring stamp duty, not incurring capital gains, and that being a fairly seamless process. It then converts to an investment property, and all of a sudden you've still gotten the benefits of asset protection, but at the same time, you're also future-proofing any potential capital gains in the future as well.
Yep. One of those ones for sort of self-employed people out there, if you're operating as a sole trader or a partnership, essentially the business that you're operating is an extension of you. So you're an extension of the business. So you're the same legal entity as your business. So in that instance, one of the considerations, it's quite a popular structure, is operating your business from a company structure as opposed to a sole trader or a partnership, because it does create that separate legal entity. Yep. So there's a little bit of complexity here. So we might get into this in some detail. So if you're a sole trader, and let's just say I'm a local tradesperson, and I go to Bunnings and buy all of my material from there, and all of a sudden I owe Bunnings 50 grand on trade credit.
Yep.
And my business collapses because I mismanaged it, or whatever it may be. Because I'm a sole trader, I'm personally liable in my own name for that $50,000. Now that's the right thing to do, because I incurred that cost. In the same example, if you're a company, then the legal liability of that $50,000 stays with the company.
Yep.
Now, during the time that you signed up for the trade credit with Bunnings is probably a bad example, but did you sign a personal guarantee? So what that means is, if you signed a personal guarantee, if the company cannot pay its debts, that liability then transfers across to the individual.
Yep.
So if you haven't signed the personal guarantee, then essentially the liability stays with the business. So there's a little bit of complexity around being able to protect from creditors and bits and pieces like that. And from a trade creditor perspective, it's getting more and more common that we are seeing personal guarantees being signed. If you consider borrowing money from the bank, there's usually for property, they're always going to ask for it they've got security over the property with a registered first mortgage, and they've got personal guarantees from the borrowers as well too. So in that instance, from a banking perspective, what we're saying does not apply to a bank, essentially, because they've got the system worked out that they're not prepared to lend money and assume that risk.
Yep. Yeah. So one of the considerations would be potentially, having it in the company structure and making sure that you're not signing any personal guarantees, so that from an asset protection side of things, there's some sort of limitation that can be accessed. Another really fantastic investment vehicle, which kind of hits both from a tax perspective, but also in addition to that, from a wealth creation perspective and a protection of asset side of things as well, is superannuation. Superannuation is an asset that generally isn't touched in the event of an insolvency. And I say generally because all of the things that we're discussing here, they will work protecting your assets, provided that you're not doing it when the writing's already on the wall. So argument's sake.
So you're not doing a dodgy.
Yeah, exactly right.
Don't do a dodgy.
Or make sure that you're planning for it early before you do the dodgy, not to
I just wanted to say dodgy.
But I mean, one of the examples is if you're making superannuation contributions, you've been doing so for the last 10 years, and something happened within your business, and as a result, you've got this massive liability that you can't pay. You go insolvent, and all of a sudden the assets within your superannuation, they're protected. You look at the same scenario, and it's a business is struggling financially. They're not being able to meet all of their repayments. The owners of that business see the writing on the wall, and just before they decide to declare bankrupt or to shut down the business, they make massive contributions into superannuation in order to protect those assets. In that instance, it will be accessed. And so, you really need to make sure that you're doing this as a preventative measure and you're doing it in good faith, not something that, you just put money in and all of a sudden it's protected and now I can go on my merry way and still retain all of my assets.
Yeah. And look, I mean, from a strategic perspective, that's something that we advocate for a couple of reasons. I mean, from a wealth creation vehicle, I don't think you could go past superannuation from a taxation effectiveness perspective. But if you consider that superannuation does not form part of, that pool, if we then think about, say, your small business owner, where if you're not an employee of the business, I mean, even if you are, nobody's going to stop you, but, you may not necessarily be paying yourself superannuation. In the event that you think, okay, I don't need to pay super because I could use that money better off in my own hands, in my own business and create a better rate of return. And, there's an argument to be had associated with that. But I've heard it time and time again that my business is my super. If you put in, a whole career of building a business and then something goes wrong, then, you could potentially lose it all. But if you haven't done a dodgy, that's the new technical term of the day. No, if you haven't done something untoward and your business does collapse, if you have been paying yourself superannuation over all of those years, then you've got money and wealth tied up and preserved in another vehicle. So from a wealth creation and protection perspective, we always advocate for small business owners, even though it's the right way to do it and it's the legal way to do it. And it puts more pressure on cash flow, but paying superannuation definitely makes sense for a whole bunch of reasons. But yeah, really good vehicle to be able to isolate that out, assuming that it was done correctly and it wasn't done with the intent of trying to sidestep any creditors. It's a perfectly sound strategy to consider.
Yeah. And look, you also look at it and say, as a part of protecting your assets, one of the things that become quite difficult for a lot of business owners to do and get their head around is, okay, I need to convert at some point in time. I need to be able to convert my business assets into personal assets. I need to create business wealth, or I need to, turn my business wealth into a personal wealth, because that's eventually what's going to, provide me a retirement income and provide me all of the things that we try to build wealth for. The issue with exactly what you're saying, which is, my business is my superannuation, is my retirement plan, is you're putting everything on that one day that you exit, rather than doing it over a period of time. You convert business wealth to personal wealth over time, and you're averaging out the time that you're selling out, and you're averaging out some of the risk that's associated with it. But, you consider AI, you consider industries that have been disrupted by AI, and all of a sudden where your business valuation would have been up here is now, maybe down here. And so it's not just your business has collapsed or you haven't been able to pay your creditors or anything like that. Sometimes it's my exit point from the business. I'm doing it, over the course of a number of years. And so I'm reducing the risk that the valuation is not necessarily, at the bottom.
Yeah, I just thought of a really perfect example. Let's assume that that's the case. I continue to do it. I then get to a particular point in time and I put the business for sale. Imagine if you're the sole person that's responsible for generating, the wealth, the sales in the business and delivering the products or services. What if you did that, everything's going well, and then something happens, you get sick or injured? Your business valuation is going to go through the floor. Yeah. If it's going to be worth anything, depending on what type of business that you've got. So I think we've made a worthwhile case that, that's something that we see all of the time for small business owners in particular, and using it as a wealth creation and a protection vehicle ticks so many boxes in my mind. But Andrew, on a financial product perspective, there's other products that we've got out there that we talk to people about. What are some of the other things that we can look at and consider when it comes to asset protection? Yeah,
I mean, look, from a product perspective, superannuation is one of those, you talk about long-term bucket, you talk about, great from a tax side of things, but very, very, very illiquid, because if you're, talking about someone who's maybe 30 years old, can't access it until you're, 60 and not working at the moment, or 65, depending on your time frame or depending on your working status. Some of the things that can sit in that middle ground is, considering things like a growth bond or an investment bond, things that aren't necessarily that long-term in nature. A lot of these investments are, 10 years in order to receive the benefit. You can access the funds early if you do need it, but it can provide some of the similar protection that superannuation does, in that those funds aren't possible to be accessed by creditors in the event of liquidation. And so potentially slotting something in that middle ground where you say, okay, long-term bucket superannuation, medium-term bucket maybe is your growth or investment bond, and then maybe you've got assets sitting in a trust or, a structure that is also separate to yourself personally that can also add that liquidity and still give an element of protection as well.
Yeah, yep. One of the other things, really simple one, sort of not necessarily on the same pathway, re-creditors, but just in terms of how do you protect wealth. This is more so in the event that something happens. So we're talking insurances. So if something happens, how do you maintain the financial position of the family unit? One of the ways of being able to do that is through personal insurances, life insurance, disability cover, crisis cover, and income protection. So basically the idea is if something untoward happened, then there's no financial detriment to the family because you've got those insurances in place. So a bit of a different take on the creditor angle, but once again relevant when we are talking asset protection, because outsourcing the risk to a third party, being an insurer, is definitely a worthwhile exercise to go through. Yeah,
and even considering, from a business perspective, key man insurances, buy-sell insurances, things that may impact the business if anything untoward were to happen. But there's, a range of different strategies. There's a range of different insurance products that are available to make sure that, from a health side of things, or if anything were to happen to you personally or to someone who's, a key person within the business, there's a risk mitigation strategy that's ultimately in play.
Yeah. Andrew, I think we did that one justice. Well said, well summarised.
Absolutely. And hopefully our listeners and our viewers, hope you all got some good value out of that one. And if you did, subscribe, and we look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.